With 2025 almost in the rear view mirror, we're having a look at what worked in the markets this year and what didn't, and what might lie ahead for 2026. Joining us now to discuss all of that, Vitali Mossounov, Managing Director and Co-Head of Research for Fundamental Equities with TD Asset Management. Great to have you back on the program.
Always a pleasure to join you here, Greg.
This is the time of the year. I know you've got young kids, I've got older kids. You still, no matter what age you are, you got to make the naughty list, you got to make the nice list and try to figure out who is worthy of what. Let's talk about what's been nice in the markets this year.
Well, I have to say first, at home, everybody made the nice list this year, so that's good. But they're still small, so not too many problems yet. In the market, it's different. The market every single year gives us a lot of nice and a lot of naughty. And this year, I wanted to do a bit of a Santa's list here and unwrap, if you will, who's been good to us and who has maybe who has disappointed.
So let's start with that. Who has been nice?
Let's start with gold. Maybe the best Christmas gift one can get. But
I wouldn't mind a bar of gold.
I wouldn't mind a bar of gold. I'm hopeful. Yeah. Look, let's go back to 2024. Gold already made the list for us. It was up 35%. I'd say that's a pretty good return in any year. This year, gold is up 65%, and gold stocks are up more than 100%. So absolutely booming gold and gold equities prices. Most years, you don't hear too much about gold. It's an underperformer usually, right? It has these runs. And so usually you'll hear the bears talking about, listen, gold, it's not a good diversifier. It's just a rock. It's just a metal. It doesn't pay you any interest like a fixed income instrument would. Why would you own it? But the bulls come out when uncertainty is bred. And we have a lot of uncertainty. Uncertainty about deficits, fiscal stimulus and spending, currency, AI, and what it means for the future of the world. And gold has come back strong. The buyers have said something's going on. We've seen central banks having a couple of years of really strong buying. And of course, retail investors have come in drones to support gold.
So it's hard to argue against gold in 2025. How about the data center trade? AI continues to roll through for us.
AI is booming. Now, you wouldn't know that on any given day. As you mentioned in your opening remarks, sometimes we're down 10, sometimes we're up 10. And that's because most of the value of AI is out there far into the future. And when something's so far into the future, the news headlines that are emerging every single day are really controlling the narrative and causing investors to reevaluate their decisions. That's not healthy. But if you take the bigger picture, this has been a great year for data center and AI stocks. Semiconductors, industrial equipment, whether it's gas turbines, uninterruptible power supply, networking equipment, power infrastructure, CapEx is really driving big spend and this data center trade as a result. $400 billion in CapEx for the Mag 7, that's enough to make a lot of people happy.
When I think of what we're going to throw at here now, financials, what an interesting grouping to say what's been good for investing. Gold, data centers, and financials.
Financials, and many wouldn't have bet on this one making the list. Probably AI and gold were easier bets, already a lot of momentum there. But with financials, a bit unusual, up 50% on a global basis. Because with financials, what you would often expect is when there are interest rate increases, the banks can make more money. What they receive for the loans that they make, that gap stretches over what they pay depositors like you and me. That's a good thing. But 2025 has actually been a year of compressing net interest margins because we're seeing interest rate cuts already going through the system here in Canada, first and foremost. And so why the banks? Well, a big reason is credit remained benign. So these PCLs that they report consistently have been just okay. And equally importantly, they're fee-bearing businesses. And what is that? Wealth management. Markets are higher, wealth management does better. Capital markets, more trading. Equity, fixed income, there's volatility in the market. That's good for capital markets businesses. And finally, advisory. What's advisory? M&A. Well, with the Trump administration being very friendly to the business climate of the United States, people are hopeful, and we're already seeing some large deals getting done or at least being floated. Of course, Netflix most prominently, as much as $100 billion in potential M&A. Good stuff for the banks.
All right, so that's the nice list. It's not the holiday season without the naughty list. What's the top of that list?
Well, the market's got two lists. In the naughty list, we've got some candidates. First and foremost, I'm going to put oil right up there. Oil down 20% this year. It's surprised many, but when you look at the fundamentals of oil, it should not be surprising. And really the culprit here I want to call out is OPEC, the so-called Organization for Petroleum Exporting States. What they've been doing is really unwinding supply cuts that they had before. about 2.2 million barrels, bringing it back on between April and September, and announcing another 1.6 million barrels that they can make available in October. More supply, and look, the amount of oil that we need with the current industrial backdrop is not that much. So even heading into next year, we think oil inventories continue to build by as much as 4 million barrels. Oil has struggled. But I'll give you a silver lining, if you'll permit me. There is one with oil, especially for Canadian investors. Canadian oil stocks have done well. Canadian oil stocks up more than 10%. They've held in more than 10% this year. And I think a lot of that comes down to just these businesses being well run, capital allocation, capital discipline, proving to investors that while oil may be volatile, we're a steady pair of hands to handle your money.
Now, when people hear about the market rally and they think about the drivers, they think, oh, it was about tech. Tech, there's different kinds of tech, right?
For sure, yeah.
Some might be surprised to see software companies showing up on the naughty list.
Absolutely. Software down 30% year to date. I mean, it's just kind of the mirror opposite of semiconductors. And that makes sense if you think about it. Reflect on semiconductors, what they're enabling. If they're enabling AI, they're enabling a technology that suddenly makes it very easy for anyone really, not even a developer anymore, to go and create new software.
You're like leapfrogging all
You're leapfrogging. And so if we're now democratizing coding, programming, development, and permitting startups to create new software, it's a big question mark for the existing software franchises. And why it's a particularly big question mark is software historically has been a great business. 80% gross margins, 40% net profit margins. And so these startups are looking at these big, fat margins and saying, I can do that at a fraction of the price. We haven't seen the impact of this yet, but the big fear has been, oh no, prices are going to come down for your products. I'm going to sell the stocks ahead of time. I can't wait until 2026 to see how this debate resolves.
All right, so that's oil, that is software companies, and the third one on the naughty list, consumer stocks.
Yep, let's put the consumer there. And the consumer is a tricky one because we have seen the higher income consumer in the US and worldwide doing rather well. The middle income hanging in there, the low income consumer unfortunately suffering quite a bit. But consumer stocks as a whole have just not delivered. We'll call them flat, underperforming the market for sure. And if you think about consumer, there are the staple-like names, the toothpaste and the toilet paper and all that stuff, the Colgates, the Procter & Gamble's of the world. They're supposed to be defensive. They haven't been. Some of those stocks are down 20, 30% this year. And then there's the discretionary, right? When we have a little bit more money in our pockets, we're probably going to have some fun, right? Go to a restaurant, catch a movie, maybe even get a flight. Well, those stocks haven't done well either because in this somewhat troubled consumer environment, inflation's still a little high, rates are high, and wages are growing, but not as fast as some would like. I think that discretionary purchase, people have been holding back on it. And so whether you look at the stock of a Ferrari, people seem to be pulling back just a touch on that. Or even something as simple as a more upscale grocery store. You're seeing it across the board, the consumer's hesitating.
I'm going to stick with the two Ferraris I already own. I don't need a third one for 2026.
They go up in value, I hear.
So I'll just hang on to it. So for 2026, we've done the naughty list, the nice list. What about the wish list?
On the wish list for 26, I just say we have to look through this noise, right? Right now, these last 2 weeks, as we're all watching the markets, up 5, down 5, up 5, down 5. And you said it perfectly. And some days it looks like the AI trade is ending and the world is ending with it. And other days it looks like we're just back off to the races. So I think it's not so much as a wish list, but a counsel from me to your audience, which is discipline. Make discipline the key word for 2026 because AI is a fundamental technological theme, is here to stay. The rate of change, the pace of change in 26 will be faster than it was in 25. It'll be disruptive. And the market is going to respond to that in volatile ways. And that's on top of everything else that's going to happen in our current, let me call it, interesting geopolitical climate. So be disciplined, do the fundamental work, and don't try to time the market.